I'm Roger Lasad, and I love real estate. Today, in episode 18, we are discussing why homeowners are racing to sell their houses now. Let's get into it. All right, everyone. So it's been over a week. Haven't posted videos. Sorry about that. I've just been crazy busy, and then when I get home, I'm like literally dead. But with everything that's going on, I definitely wanted to go over what's been going on in the market and then discuss what's going on with homeowners that are now choosing to put their homes on the market where previously they had waited. And let's talk about that. So let me share my screen here and let's take a quick note. All right. So, number one, you may have heard this. Some people may disagree. Some people may have a different opinion, but as of last month, GDP, which is the gross domestic product, which is essentially everything that the United States produces in a year, fell by 0.09% for the second quarter. Now, in this article, it says this is the second straight decline and a strong recession signal. This is from CNBC, which to me is the most reputable news outlet out there currently, especially when it talks to when it comes to economic and financial news, because they essentially are putting information out that helps stock investors make decisions. So there needs to be a certain degree of reliability with this information they're putting out. So with that being said, guys, technically we're in a recession. I say technically because this recession, um, unlike others in the past, is very different. One of the ways it's very different is because we still have a strong job market. And I know some people are saying, well, that could change, and a year from now, we could be in a very different situation, but we'll definitely see. So, the first thing I want to impress upon everyone watching this video is that from a technical standpoint, which essentially means um, GDP falling for 2 consecutive months, or another way to put it, the economy contracting. This has happened, and generally speaking, this is the main metric that's used when determining when we're in a recession. Okay, so let's move on to the next article. So this was from South Florida Agent, and this is drawn from CoreLogic, which is one of the companies that provides data to the MLS. So in Miami, home prices increase top national average in June. And just to sum up, in Miami, home prices were up over 25% year over year as compared to 18.3% nationwide. So a couple of things to take away from this for those guys that are waiting for the crash or for things to turn drastically. If you're in the Miami market and you're looking for a home, for this to make sense as the deal that a lot of people I know that have been sitting on the sidelines since 2018, 2019. I mean, even if you had bought your home exactly a year from now, you would have had the appreciation would have been 25%, which means you would have made 25% in equity. Not necessarily 25% on your money, unless of course you bought it cash. But since most people are putting down 25%, yeah, this is substantial. So, and even nationwide, they're saying nationwide average 18.3%. All right, let's move on to the next article. This comes from Phoenix Agent Magazine. Rental and homeowner vacancy rates still near historic lows, census data shows. All right, so national rent vacancy dropped to 5.6 and homeowner vacancy rate at less than 1%. So this is stating that we still have a very strong rental market and a very strong housing market. All right. Foreclosure activity. Now, I know everyone was under the impression that foreclosure was going to skyrocket with the end of the moratoriums, the end of, like the eviction moratoriums, a whole bunch of other things. They thought that there was this backlog of foreclosures that haven't really made it through the court system. And we'll see. Maybe that will come to fruition, maybe not. But at least for right now, it looks like in July, foreclosure activity actually dropped versus the previous month. Now, this article does state that this could simply be a seasonal occurrence, and it's stating Florida once again is extremely strong. Um, and that's the main gist of that one. Now, this is one was definitely a bit of a shocker. Like, obviously, mortgage rates have been going up. However, mortgage rates has actually come down. So the reason that happened is that the banks and the financial institutions that lend money had priced in to the mortgage interest rates the rate increases that they felt the Fed was going to do, which they pretty much have been on track for the predicted rate increases. And I think, and this is just my personal opinion, I think the banks are probably seeing more of a pullback as far as people applying for mortgages, and that's probably caused them to say, you know what, we might have been a little bit too overzealous in raising them as high as we did. And let me back up. So the Fed fund rates are what determines the prime rate, and the prime rate is what the financial institutions lend, and they usually add like a couple of points on top of the prime rate because the prime rate, well, I'm not even going to answer because I'm not 100% sure what the prime rate is as far as a actual definition. But I know that is the rate that they use, and it's affected by the Fed's fund rate, and the banks usually put a few points above that, and that those few points above the prime rate is the profit that they make. So, in my opinion, it's just my opinion, it seems like they probably overestimated what the market was willing to bear as far as mortgage rates, which is evident in the fact that mortgage applications are down severely. So I think this is what caused them to pull back a little bit on the interest rates. Now, this is from Florida Realtors. Growing share of listings on market for 30 plus days. Now, this has been going on for a little bit, and not only are listings staying on the market longer, but the buyers now are starting to become more and more demanding. Where a few months ago, it wasn't uncommon to get multiple at asking or above asking offers with zero contingencies. What do I mean by contingencies? Generally speaking, in a more balanced market, you can expect to see buyers making offers and they want an inspection contingency, which basically gives them a certain amount of time to inspect the property and walk away from the contract without their deposit being at risk if they find anything that's out of order or needs fixing, etc. Then you have the appraisal contingency, which would state that if the house does not appraise at the contract value, that also gives the buyer the ability to walk away from the deal. Oftentimes, buyers and sellers will renegotiate that point, et cetera, et cetera. And then we have the finance contingency. The finance contingency states that within a certain time period, if the buyer is unable to get financing, and here's what's very important, they have to send either written or some type of legal communication to the seller within the finance contingencies window stating that they were unable to get financing. That also allows them to walk away from the deal without their deposit being at risk. So now we're seeing more and more contracts where buyers are insisting on having these contingencies in place, whereas before we really weren't seeing these. And this also adds to the fact that, and it's mainly because obviously buyers think they have more leverage now because obviously homes are staying on the market for longer. And this is another one from the Florida Realtors, and this is from Fannie Mae. Buyers wary of the housing market. So, according to this article, buyers' feelings about the current market are that only 17% think it's a good time to buy a home. And they're also stating that the good time to sell index has also dropped, which let me see. So yeah, so in July it fell to 67% from 76% in May. So, obviously 70% of buyers think it's a good time to buy, and only 67% of sellers think it's a good time to sell. So then the question is now, with all that information I just told you, why are sellers racing to sell their houses now? Well, it's for a few different reasons. The first reason is, as I stated before, the recession's here, and unfortunately, people, that equals fear. One of the things you'll learn when you get into sales very early on is that the vast majority of people, most of their decisions are made using emotion and then use logic to rationalize those decisions. And what we're looking at is a perfect example. So even though this recession is an unusual recession, it is making people feel very wary. It is making people feel very anxious and nervous. And with that being said, you've got a lot of people that were speculating. You have investors, you had people buying properties mainly for appreciation. I mean, I've always said this before, and I think Mr. Wonderful Kevin O'Leary from Shark Tank has the best saying on this, which is, if it does not cash flow, just say no. And that's something I stress to investors that I work with the exception of a handful that are very high level investors that they have their strategy. But these are guys that have been doing this for like 30, 40, 50 years. So with with them being the only exception, for most investors, speculating on appreciation is extremely dangerous. And honestly, it's very close to gambling. I'll give you a perfect example. I was sitting at a table with a group of investors. I was by far the youngest person there. Everyone there was late 60s and over and had been investing in real estate literally before I was born. And just so you guys know, I'll be 52 in August. So when I asked them, what their thoughts are on what the market was going to do or the future of the market, they all looked at me like I was foolish. And one of them basically told me that if he knew what the market was going to do in the next several months to a year or two, he would also know what the market would have done during the last financial crash of 2008. And he said if he knew what was going to happen then, he could have bought the entire state of California. Now, he said this facetiously, but based upon certain things I know about him, he probably wasn't exaggerating that much, to be quite honest. But anyway, the bottom line is it's very hard to predict what large numbers of human beings are going to do, i.e., stock market, real estate market, etc., which is why speculating can be very financially dangerous, which is why I don't encourage or recommend that people engage in speculation. What I do recommend is that you buy properties that are income producing. And if it does appreciate, especially if you hit some type of home run, that's just a bonus. But now let's get back to why sellers are racing right now to put their homes on the market. And like I was saying, I mean, fear is a great motivator. Now, with the investors and the speculators, so a lot of them have done well. A lot of them that got in early on, or even those that jumped on the bandwagon that have some appreciation. I'm thinking a lot of them are looking at everything and they're thinking now is a good time to cash their chips. They're thinking that they've gotten to the top. In fact, some of them are probably thinking that not only that we've gotten to the top, but I missed the top. So now they're in more of a fear mode where it's like, well, I want to sell and lock in as much money as I can get now before my opportunity dwindles away. And this is the thing I've always found fascinating with human beings. It seems that it seems that people are more inclined to sell when the prices of their asset is going down than the price of assets is going up. And they're more likely to buy when the price of assets are going up versus when they're going down. And I know there are certain people watching this that will say, oh, that's not me and blah, blah, blah. Well, I've been talking to a few people. I'm like, whether they realize it or not, it is you. I mean, as I pointed out to a few people, and as we just saw, if you had bought a year ago, you could have made, in the Miami market, you could have still had 25% equity. If it was 2 years before, you're looking at 50, and even 3 years before, it would be even much more. I mean, but anyway, that's another conversation. So we do have the investors and speculators that are trying to cash in their chips because they've probably looked at it like I've missed the top in the market. I better sell now and lock in my gains. And then next on the list, we have the FOMO people, which are kind of similar to the investors, but I'm talking about the regular end users, the people that bought their houses and maybe they bought it with the idea that they would hold on to it for a relatively short period of time and then sell it. These are less sophisticated, as well as the people that have had their houses for a while and they saw all these prices going up and they were thinking, well, I guess they were thinking this was going to go on forever. And to a certain degree, they were like, I guess in the back of their minds, trying to time the market perhaps. And now that they've seen that prices are coming down, interest rates are up, they're like, oh my God, Johnny, we've missed our opportunity to sell. That that dream about having that the 100-acre ranch out in Colorado or Montana is starting to slip away, and now they start to panic. And there's definitely some of that going on. And we also have stuff happening from distressed sellers. So obviously we aren't in a recession. I mean, technical or not, it is a recession. The economy has contracted. Now, and by saying that, let's talk about how the recession starts or what happens in the beginning of a recession. So, thanks to the pandemic, there were a lot of companies, a lot of businesses that, in addition to ones that went out of business, there were a lot of companies and businesses that had to contract the amount of stuff that they were buying because people were buying less, right? So most businesses and companies don't keep inventory on a day-to-day or hour-to-hour basis. Like most companies are not like Amazon. So when COVID hit and it caused, and obviously demand dropped, they basically stopped fulfilling orders, 3, 6 months, 8 months, a year down the line. And then when things started ramping up again, that caused a huge bottleneck when they tried to source those as well. Now with the economy cooling, they're in the reverse of what happened in COVID. Now they've got an oversupply of inventory. So when they have an oversupply of inventory in some cases, or in some cases, not only do they have an oversupply of present inventory, they have an oversupply of stuff that they ordered when the market was hot, but because the supply chains are broken, it took so long to get here. Now they have things coming to them based on numbers of like, 90 days, 180 days ago. So now they're seeing that the market is cooling, the economy is cooling, which basically means there's going to be more people buying less. That's going to cause them to lower prices of their goods and services. When they lower prices of this goods and services, that means that this is going to lead to them doing other things to cut costs in other areas, and that is going to result in layoffs. Now, as more companies cut costs and lay more people off, that means there's less people to buy goods and services, including real estate. So, and that's gonna kind of, and in bad recessions, that kind of has a snowball effect. Whereas more people get laid off, less people have stuff to consume, have money to consume. The less people have money to consume, the more prices have to come down, which then equals more people getting laid off, and it's just this huge, huge snowball that ends into a big recession. And usually it takes something like the Fed doing something provocative or serious, like cutting interest rates, to input more money into the economy, which then gets it kickstarting again. So hopefully we won't have a deep recession. Hopefully, we'll have what's called a light, soft landing recession, where yeah, certain things are gonna get cut back. Some people are gonna lose jobs, unfortunately, but hopefully those people can find jobs in other industries. We still have a shortage of workers in a lot of different industries, so there's some hope there. And hopefully things won't be that deep. But the main thing that's very interesting to me is that with all of this stuff going on, you have a bunch of people that are now throwing stuff on the market. And realistically speaking, I mean, they would have been a lot better off if they had done it a couple months ago, where they could have got top market. So to me, it's just fascinating how people tend to wait on the last minute to act, even when it's in their best interest. And I think a big point of this is because people are always trying to time the market, or people just have this belief that they're somehow special and smarter than the other 330 plus million people in this country, and that they somehow have some special insight, or yeah, or some type of certain knowledge that allows them to see things that millions of other people don't. So, but anyway, to recap, we definitely have investors that are trying to cash out. We have people that are afraid that they might have missed the top and they're trying to cash in. We definitely have distressed sellers that are beginning to feel this as well. And yeah, it's going to be an interesting ride. I'm going to keep monitoring the market and update you on what I see as far as in the local South Florida region, as far as nationally. But yeah, this is for buyers that are in a good position. I think you could find some. There's greater potential now to find good deals, and by deals, I mean prices that are more realistic. I mean, we definitely uh went into a mode where things were definitely overpriced in certain markets. And I think with all these changes that are happening, we're going to go into a more balanced market, and I think it will definitely be an opportunity for buyers, especially those buyers that are a little handy and don't mind a little bit of sweat equity, and buying houses that need a little bit of work. Those are probably going to be where you could find some of the best deals, as well as those that are very observant and will drive around their neighborhoods and have no problem going up and talking to people. Another thing to keep your eyes out for is if you go to a neighborhood where all the houses are excellent, but then there's this one house that looks like they started some construction project or rehab project, and it looks like it's unfinished. And the easiest way to tell that is if you go down by the house middle of the day and you don't see anyone there working on it, and something looks half done. It could be a pool, a roof. There could be some opportunity. It might be worth it for you to stop your car. If you see a neighbor or someone walking their dog or something, just stop your car, ask them, and see if they know what's going on with that house. So yeah, guys, so we're definitely in a cooling market. This has caused some fear, and that fear has come out in several different ways. And the good news is for buyers, you've got some motivated people putting their houses on the market, and I think it's something that buyers can capitalize on. Anyway, guys, I'm Roger. It's been fun, and I'll be back with you soon with another video. Hope you enjoyed this. If you got something out of this, don't forget to like, comment, and subscribe. All right, guys, you have yourself a good evening.